some common mistakes when it comes to debt recycling. Glen Hare is joining us from Fox and Hare Financial Advice. Glen, welcome back. Good to catch up with you again.
Good to be here.
All right, so we're going to sort debt recycling. For those unfamiliar with how this works, just tell us what it's all about.
Yeah, sure. So debt recycling is essentially where we are turning what is non-tax deductible debt into tax deductible debt. And coming into the first of the three common mistakes I see people make when it comes to debt recycling is actually understanding what it is. So if we've got our primary place of residence and we've got a mortgage against our home, and we essentially borrow, we just use equity in that property and we increase our debt level to invest elsewhere, although that interest on that loan would be tax deductible, that is in fact not debt recycling. The true definition of debt recycling is where we actually need something to recycle. So what could that be? It could be a myriad of things. So first, it could be cash sitting in an offset account. So if we've got 200 grand sitting in a offset account against our home, we could then take that cash, pay off a portion of that debt, and then borrow the $200,000 to then invest in the stock market. Or elsewhere, really. Shares is a really good one. So if we've started a share portfolio on the side and we've built that up over a number of years, we could then sell those shares, pay off a portion of our home loan, redraw against our primary place of residence, taking out an investment loan, and then reinvest back into the stock market. Again, recycling and turning that non-deductible debt into deductible. Another one is property, which often doesn't get spoken to, but a really relevant example was one of our members. She had paid down her primary place, so she'd paid it down over time, and then that property in fact then turned into an investment property. But what she had done is she'd then paid down all the debt on her investment property, and then she bought a second property, her primary home, and all of that debt was non-deductible. So what she essentially did was she sold the investment property. She then paid off her primary place of residence, her home loan. So it really paid down a lot of that non-deductible debt. And then she used the equity that she had then created in her home to then go buy another investment property. So she actually recycled property through in this manner as well. So the first of the three mistakes is people just understanding what it in fact is.
Well, so just to be clear though, you need cash and debt at the same time, and in terms of an investment.
Correct, exactly right. So we need cash or shares or property or something that we can then use to then pay down that non-deductible debt, then giving us the ability to then redraw and take out an investment loan, meaning that it inevitably becomes deductible. Because when we're just using equity in a property, if we've got a $500,000 home loan and we borrow an extra $100,000, we're not recycling anything in that example. We then end up with $600,000. Whereas why the debt recycling strategy is so attractive is that it doesn't actually change our overall debt positioning, but it just enables us to use this debt in a more tax efficient manner.
So Glen, you talk about three common mistakes. So the first one being just understanding how that debt recycling structure works. What are the other two?
So the second would be understanding what determines whether debt is deductible or not. So another common mistake I've seen people make is they have, again, I'll use the family home as an example. So let's say that the home and the debt is owned in joint names. They then borrow against the family home and then invest only in an individual name. And the challenge with that is, in order for debt to be deductible, so an investment loan to be deductible, it needs to generate an income. So if you're in a relationship and you've borrowed, you've taken out an investment loan in joint names, but you only invest in an individual's name, you're then, in terms of the deductibility, only the person that you've created that investment account in or who's generating an assessable income will in fact be able to claim the tax deduction on the interest paid on the investment loan. So we want to make sure that any investment loan that we do take out, in order for it to be tax deductible, the name that you take the investment account in needs to be in joint names. If in fact you're borrowing in joint names, for you both to be able to claim the tax benefit.
All right. And thirdly, what's the issue?
Third, to avoid, to really ensure that when you are taking out an investment loan, you structure the debt appropriately. So, although not specific advice, it's general in nature, I would encourage you to think about having a separate facility as opposed to just redrawing against your existing home loan in order to invest. And the reason why I say that is when you go to then do your tax return, it's going to be very confusing for your accountant to try and determine what is in fact deductible and what is in fact not. So I would strongly encourage you, even if you're using the one asset, so you're using the family home, to really separate out what is having one facility for your home loan and a separate facility for that investment loan. So when you go to the accountant at the end of each financial year, you can very clearly let them know that any interest paid on this particular loan is deductible because I've used that for investment purposes.